Good morning. Welcome to the last trading day of 2018. I'm Lata and with me full house today. Anuj and Sonia. Well, 2018 eventful year, isn't it, Anuj? In the sense that India actually outperformed most major markets. I was going through the list. We are, Nifty's as of date, I mean, we have one more trading day left, is 3% higher year to date. And the Sensex is about 5% up year to date. And there's only, I think, Brazil which is ahead of us. Otherwise, it's an outperforming market considering all the negative news that we have had, Nirav Modi scam and stuff like that. Not at all been a bad year. Not at all been a bad year. Good to be back. Morning, Sonia, morning, Lata. And I tell you something. 2018 was I just written an editorial on this and it will be up on our website very soon. 2018 was the reality check that the market needed. After 2017. 2017 was the year when the market was so forgiving. You could buy dirts, you could keep them, and at the end of the next 1 month, 2 months, you could feel good about you. A lot of us felt good about us. A lot of fund managers felt good about them. A lot of companies, CEO felt good about their stocks. 2018 changed all of that, and it always is going to be a case of mean reversion. 2018 was a year of mean reversion, and now that it's going through, and I tell you something, 2018 in some senses was a better year than 2017 because if you it's almost like when the paper is easy, and a lot of people get 20 out of 20, they then there's no differentiation. And the paper is tough, you have half the class flunking and, 2 or 3 who get, A grades, then you feel good. And I think in 2018, those who made money would have felt really good because this was the year which tested the skills of a fund manager. It tested skills of a trader. It tested skills of investors alike. And a big salute to the retail investors because they kept the faith in 2018. Perhaps 2019 would reward them. What's your take, Sonia? At least when ending with a bang, India won the match. It would have been a follow-on and an innings defeat, but maybe Kohli played safe. But nevertheless, we are ending it on a high.
We're ending on a high, and this is the last bazaar of 2018. I mean, we've been working all year, and now this is the end of the year. So, I mean, just to put it into context, in December itself, if you look at the way things have shaped up, the MSCI India index was down just 0.3%, while MSCI Asia ex-Japan was down 5%, MSCI Emerging Markets was down 5%. So India outperformed not only in December, but in the full year. I mean, even in the full year, the MSCI India index was down just 7.5%, while the other markets were down 15% apiece. But the big question is, will that outperformance continue, right? Because we have so many big cues lined up.
No, my own sense is for today, we should be able to continue with the December outperformance for 2 very lame reasons. One, we are about the only market which is working full day. All the other markets are, in Asia, the few of them that are working are going to close in an hour or 2. The US markets will barely trade and they will not trade tomorrow. So today is very easy NAV management day. And therefore, I think there shouldn't be too much of gloom. There is only one point which is going to be a negative. That, yes, on Friday, after the markets closed, there was a huge spike in bond yields. I mean, it went to almost 7.4 and then ended at 7.39. That was because of a Reuters report that there's going to be a huge farm package coming. It was reiterated by by Aaj Tak. But actually, it was we who broke that story the day before. Timsy had put out, the package, and 2 days earlier, Lakshman of Aawaz had put all the 3 packages which the PMO and the Niti Aayog are going to consider. But for some reason, that Reuters report was taken more seriously, or maybe, there was someone just wanting to short the market, take some profit home. But the bond yields went all the way to 7.39. See, that's where they've ended on Friday. This might be an initial negativity for NBFCs and PSU banks. But my sense is there was a lot of technical factors also, in the sense there was a bond auction. So there were some, algorithmic trades triggered over there. When you had to buy the bonds at a time when the sentiment was negative, yields kind of shot up. So my sense is it will get corrected, but there may be an initial red start for financial stocks.
Okay, there may be an initial red start, but we did see, of course, a lot of buying from DIIs as well, right? Almost 1,200 crores of buying is what we saw. Anuj, hi, welcome back. The market has done fine. I mean, over the last couple of weeks, it's held up quite well. You get a sense that it could sort of maintain that trajectory?
At the risk of, since it's cricket season, at the risk of being a bit rusty today, I I didn't see the markets for the last 2 weeks while I was away, and of
good.
course,
That's why you wrote a good editorial.
So the only thing I did was that on 26th December, Boxing Day, I think it was. I was sitting on a beach, and there was an Aussie who was sitting next to me, and we were just having a conversation, and he said, and then he said, okay, you know about stock markets and all. I mean, we're just having some conversation. He said, yesterday the Japanese market was circuit down. It was trading on Christmas Day, and I was surprised. I said, okay, let me look. And that day, I think the market had a big gap down, and then from 10:30, 11, I think it reversed. That was the time I saw, and that reminded me of the day that we had the election outcome, and the market made a hard bottom. So the market may have made a higher hard bottom. Let's talk about on that day. So December 26, low to high, Nifty moved about 213 points, and on December 11, that move was 234 points. So very reminiscent of that December 11 move. What that has done is given you two important support points for the market. The big support is, of course, the immediate support is that day's low of 10,535. And the big support that we all mentioned that day when the market made that really big bottom, 10,334. The only problem is 10,900 to 11,000 is a congestion zone. And if you are one of those who respects risk reward, this is not a zone in which you want to take long positions. In last 1 month, the Nifty has halted in this zone 7 times. So it's obviously a very massive resistance. So the time to buy is plunges, and the time to sell is perhaps big rallies. And just to round things off, let's look at what December has done. Sonia was making this point about this emerging market outperformance, Indian outperformance. That's, of course, the MSCI comparison. But within that, the internals are once again very interesting. The Nifty is flat, but the bank Nifty is up 1%, the IT index is down 1.7%. The point we spoke about, domestic stocks outperforming the exporters, pharma was down 5%, metals was down 1.6%, and the broader market started to do well. The Nifty mid-cap is up 2.8%, power index is up 4%, infra is up 3%. I think we are in that zone where the market wants to perhaps buy some of these economy-related stocks.
Okay. Well, we'll have to wait and see. One of the big reasons why all that purchase happened was because, the Reserve Bank's wall of liquidity came in, and there were expectations because the NBFCs met the Prime Minister that a special line of lending may come. So if capital became so cheap, then obviously it was the day of the mid-caps. But, that will have to come. Friday's Reserve Bank's report, it's called Trend and Progress in Banking. It's an annual report, statutory report. That did not give so much hope. It was still the old austere Reserve Bank saying that, the RBI will keep vigil and provide liquidity. It didn't give an indication of a special line of credit. So let us see. But they've genuinely promised a lot of liquidity in the system, and that fall in cost of capital should help. It's just that cost of capital argument doesn't gel with what happened on Friday when there was a big spike in yields, pushing up the cost of capital. So we'll have to really wait and see on whether that mid-cap rally can continue, how it is going to negotiate this farm package. Will it come? In what shape it will come? The farm package buzz came on the back of some very ugly fiscal deficit numbers for the April-November. That came on Thursday evening. That did not disturb the markets, but it was this package argument that disturbed the market. We'll have to really wait and see. It's very news dependent, or data dependent, if you please. If the government does announce something, then the bond markets will take it badly. But at the moment, I don't think today and tomorrow that fear should creep in.
Okay, well, we don't have any equity calls today because, as you know, all markets are shut globally and we're the only ones trading. But we do have some money market views for you. Pramit Brahmabat of Veracity says the rupee will remain sideways in the absence of major cues. He expects the spot dollar INR pair to trade in a range of 70.20 to 70.50.
And on bond market, Ajay Manglunia says the recent positive trajectory witnessed, the bond markets were witness to a sharp reversal of the recent positive trajectory as profit booking took over late on Friday after the auction results. However, he adds crude and the currency continue to bode well for gilts, especially the rupee, which appreciated beyond 70 to the dollar yet again. So he says the sell-off is likely to be short-lived, and yields are expected to reverse part of the losses. Ajay expects the 10-year benchmark bond yield to trade in a range of 7.34 to 7.41 today. So that was the widespread expectation. 7.39 won't stabilize. That it will come down to maybe 7.35, but that's still higher than last week's levels.
Okay, last day of 2018. Let's see how the global markets are doing, at least the ones which are trading. Here's Mangalam with the world view.
Well, most of the global markets are shut today, but for Friday's trading session, there was a volatile move as far as the Wall Street is concerned. The Dow ended almost 320 points off the highs, ended about 75 points lower. However, the Nasdaq held up mildly in the green. That was on account of the FANG stocks that did well. So Apple, Amazon, and Netflix kept the Nasdaq afloat. However, nevertheless, December has been the worst since the Great Depression. So 9.7 and 9.9% cuts seen on major US indices. And thereafter, on Saturday, we got a tweet coming in from Donald Trump. He said, just had a long and a very good call with President Xi of China. The deal is moving along very well. If made, it will be very comprehensive, covering all subjects, areas and points of dispute. Big progress is being made. So that's something that the street took heart from. Of course, that is something we'll watch out for over the course of time, because these things tend to be fairly volatile. Across the Atlantic, the European markets ended fairly higher. This was when the US markets were at the high point of the day. The Dow was higher by about 250 odd points. The resources stocks, they gained, the likes of Rio Tinto, Anglo American and Glencore. For us in India, Brent is contained around that $53 per barrel mark. And Anuja, I remember you making the point, when the whole class flunks, the ones who get an A grade feel happy. Well, when the whole class is shut on leave and one person is in the class, that doesn't feel good. You have Nikkei, Kospi as well as Shanghai, all of them closed for trade. We have Hang Seng, which is higher. The SGX Nifty is higher too.
Okay, thank you very much for that, Mangalam. And we will be rubbing that in tomorrow as well, isn't it? Where all markets will be shut. And we'll be actually the only boy in class.
Which is very interesting, because, on one hand, exchanges want to
be globalized.
Increase trading times because they want markets to be in line with the global market. In that case, to have days like, today and tomorrow where, it's frankly speaking,
a mockery. Absolutely a mockery.
It's not about us getting one extra day of leave. It's not that. If you want to align yourself with global markets, in that case, on 1st of January,
this is ridiculous. It's totally ridiculous.
I think this rant is something that we've been having for the last many years
now.
And we've seen nothing come out of it.
Okay.
But
let's get to the bond
macros,
markets. Yeah, I think bond yields we need to discuss. This sudden spike to 7.39% on Friday, on the back of news that, or rather buzz actually, that the government is mulling 3 options for farm loan packages, probably a price adjustment, money being sent to the Jan Dhan accounts of farmers whose crops are priced lower than the MSP, or a farm loan waiver for the entire country below a particular level, or a basic farm income. So the numbers put out were either 50,000 crores or 1 lakh crore or even 3 lakh crore. And that took the bond market by surprise. Amandeep Chopra, the Group President and Head of Fixed Income at UTI Mutual Fund, has joined us. Good morning, Amandeep. Thank you very much. Wish you a very happy 2019. But before that, just enlighten us on what happened on Friday. And is 7.35 or 7.4 the new normal for bonds?
Good morning, Lata, and let me also wish you, your team, and your viewers a very happy New Year. Actually, the last time we spoke, we had 2 very positive developments for the bond markets. The biggest one clearly was oil skirting around $50 a barrel. And if you recall, I had mentioned that, if oil was looking to breach $50, then we could actually see the 10-year close a lot lower than what we saw that day, which was 7.24. Since then, a couple of things have happened. Oil actually has bounced back. And if you track the more near-term performance or movements of the 10-year yields, it's actually very highly correlated to the way the crude moves. And if you were to really look at the 2 graphs, there's an uncanny similarity there. So the oil clearly, was a bit of a spoil sport initially. What really spooked the markets on Friday was, you're right, this unconfirmed news from various sources in the ministry which hinted at, much larger dose of expenditure around, some bit of populism, whether it was, farm loan waiver, and even to some extent, concerns around that they may actually do a lot more through, even announcements around a universal income scheme,
basic income
scheme, which, would have also created some bit of concern in the market. So, actually the markets were a bit heavy as far as the trading positions were concerned. They were just looking for a reason to maybe sort of correct a bit, and the people were looking to sort of book profit. You also have the quarter-end, year-end sort of phenomena today. So I would not be surprised that if there was a brief rally, you could actually see a bit of selling take place. There'll be still a few traders who might have liquidated their positions on Friday, but you could see a little bit more today. But in the absence of any further negative news or news flow, I think you could see the 10-year briefly skirting around 735. Not a very sharp rally unless you actually see the same traders jump in to ensure that the quarter closes at at a 7-quarter kind of levels, which seems a bit of a stretch at current levels. But I think you could see a 4-5 basis point initial rally, and if there are no aggressive selling in the markets, then it would actually more or less close in the 735, 740 sort of a band.
Okay, so 735 is, I think, the near term that you're talking about. What about the slightly medium term, Amandeep, as we head into the next quarter perhaps, or next 1 or 2 months? So what's the outlook on the yields?
I think, Sonia, I would expect it to be maybe closer to 7-quarter. I think if you start seeing in markets build in a near certainty of a rate cut in February, which, there is a 50-50 chance today, I think you could actually see the 10-year, trading between 710, 720 kind of a band in the next 3-month period. Little beyond that, I think, will depend largely on how you actually see, the new government formation and what sort of budget and fiscal, path do they lay out. So I think till then markets may not really move very aggressively on either side. But yes, in the current environment with oil sort of being range bound around $50-55 a barrel with, some sort of expectation from the central bank towards easing, I think in this environment, I think the 10-year should be more or less anchored around 7-quarter level.
Amandeep, I just want to know, for today, of course, there could be a bit of NAV management and bond yield management. Yeah. But come later on this week, if you don't get an assurance or if you get a louder buzz that a farm package is indeed coming, do you think the bond yields in January can still go to 7-quarter, or will that be a pressure?
No, I think then it's quite likely, like I mentioned, we would see the 10-year more around 740 odd levels. Maybe it'll retrace back to where we were before, oil cracked $55. I think you could actually see, yields moving back to a little above 740. The only driver for it to move further down could only be, again, if oil again sort of, trends back to $50. Sure. And that could, to some extent, offset the concerns one may have around, the sort of fiscal slippage.
Oh, yes. Okay, actually we did get a lot of people reading the outlook for 2019 saying that oil crashing below $50 is also a possibility. Let's see, no one's got oil right for too long a time, but we'll have to wait and see. Amandeep Chopra, pleasure speaking with you. Thank you very much indeed for joining us on the last bazaar of 2018.